pleasure for me to, I'm Marina Brogi, I'm full professor of banking and finance at Sapienza University. It's a great pleasure to be here today and to host the academic seminar series on new frontiers in financial markets and regulation, which is promoted by the Faculty of Economics of Sapienza University and Consob, which is the Italian SEC. Today, we're going to address a very momentous topic, which is initial coin offerings, blockchain and DLT. And I bring you the greetings of Professor Fabrizio D'Ascenso, who is the Dean of the Faculty of Economics. And unfortunately, he could not be here today because he had a commitment which he couldn't postpone in any way. But we also have here today Paolo Ciocca, who's Consob Commissioner, who's very, very expert in these topics. And I will hand over to him in a few seconds. And we will then go on to my opening remarks and an introductory speech by Claudia Guagliano, who is the head of the Unit of Innovation and Technology at ESMA. And then we will have two paper presentations and discussions, which will be led by Professor Panetta, who will take over from me after Claudia Guagliano's speech. There will be space at the end for a Q&A, and then Nadia Linciano, who is head of research at Consob, will conclude. Let me pass the word to Paolo Ciocca. Thank you very much for being here today. It is very, very important for us to be able to hear what you have to tell us on these important technological innovations. Thank you very much.
Marina, I just want to check if you can hear me.
I can, indeed.
Good. So, Professor Brogi, thank you. And thank you to Sapienza and all those who have contributed to this, to making this seminar happen. And thank you in particular to you, Marina, for this initiative, because it helps, and today's topic is a crucial one, but it helps setting a bit of, how to say, the some pillars on the various parts of our disciplines, and in particular today on the overall world of, let's say, crypto asset as a whole. And today we will be devoting time in particular on ICOs, on two papers, but somehow we will go beyond that. Couple of thoughts, and with no intention to preempt the discussion that will, in any case, happen during this seminar. So, in thanking you, let me also thank Nadia Linciano, our head of the Studies Division, who's the true director of this initiative, let's say, for our institution, this and many others. And let me thank those that will today intervene, starting with Claudia. And thank you, Claudia, for existing, if I may, both in a previous time in Consob as well as today in ESMA. So today you have one of our, let's say, pillars, hidden pillars in ESMA, but not so hidden because they are, let's say, true pillars were here and now in ESMA. And let me thank also those that have prepared the papers and which I went through, and will make some remarks, and the discussants too. A couple of thoughts, and again, no way to preempt, just for me to have a sort of framework, a logical framework in which to, let's say, picture the discussion that you will have today. This discussion, apparently on ICOs, but as I may understand, will go a bit beyond that, comes at a crucial moment in the market in the crypto market, and this we know. So I'm not saying anything that's just new on this. But let me also say that I'm a bit, let's say, somehow as a regulator, I are a bit worried, or are frankly worried on how things are have been developing until now on this market. It's a difficult moment because this market, as well as traditional markets, have gone through a correction, and in the case of the crypto market, a major correction on different fronts, both on individual tokens as well as on quoted unquote intermediaries or let's say exchanges on whatever. Last news of the night is the filing of the bankruptcy by Celsius, and it's one out of many. But why is this crucial? Because it let's say it renders in clear terms the absence in this market of safety nets for investors, and with this, in particular for a financial regulator, is a main issue, if not the main issue. But I'll come back to this at the very end. Today you will be focusing on ICOs. So and again, let me thank at the outset Claudia, because Claudia will be introducing in her terms, which are always clear-cut and straight, the basics of what's going on, even on ICOs. And we do know that ICOs have gone through, how to say, a bit of a first upswing and then sort of a gray situation in terms of appetite by the investors. Now, ICOs are, let's say, a good companion for Consob, as if I remember well, and ask Nadia to help me out, wasn't it 2019 when we, as Consob, had a public hearing on a paper that Consob put for discussion? So we had, let's say, comments coming in, and even one of the last physical meetings before the COVID, where we, let's say, confronted whoever stakeholders and market on what we had, how to conceive a possible regulation on ICOs. That was the topic at that time. And we did that basing, let's say, based on a, if I remember well, a three pillars approach. Let's say issuance of ICOs, secondary market, and intermediaries, if I'm not wrong. And since then, we have done, in terms of regulation, we have done quite an important step. Now, the step will be, let's say, framed better by Claudia than by me. I just want to take the basics of that. And the point is that we now have an assessed EU regulation, let's say, the regulation that has to come into force. It will take, if I remember well, 12 to 18 months. For the discussion of today, would say, let's take the 18 months, since, let's say, starting from EU official journal publication, so still it's a mobile terminus. But still, we will have 18 months, and by then, we will have one regulation for the European region. One regulation, I mean, it's a straight regulation for everyone the same. In parallel, we now have already in place the pilot regulation, which is now already being published, and on that it's waiting for, let's say, enactment into national legislation where needed, and there is some need of that even in the Italian legislation. Why do I say this? Because then we have that for the crypto assets, something is coming. For the securities, something is already there. Now, again, for securities, this is a pilot regime. It's not straight onto the market. It's still a system of, how to say, experimenting the issue, the securities going on a DLT chain, on a DLT system. This is good news. How to say, this is the part of the glass which is full. I don't want to say it's at half, a third, it's four-fifths, whatever, but it's a good part of a glass which is full, and it is the positive thing. Still, my point with you, this is not enough at all. This is not enough because, on the one hand, and this is a very much an Italian issue, we are still lacking internal legislation for let's say, on one hand, let's say, starting with a pilot regime, and this is maybe should be the easiest part, but much more crucial is for us that part of national legislation that, let's say, helps or enables issuance of securities on a DLT. We know that this part of legislation will not be provided by the EU level. This is still under national, let's say, responsibility. And on this, Italy is a bit behind. Behind also compared to major peers, Germany, France, and others, and compared to others. And this is not a good thing, because it somehow does not help the market and entering into this new competitive situation that in any case will start when MiCA will enter into force. And this is something for us. But a bit, my impression is that, and going beyond, and I don't want to go that, let's say, that far, so I'm, if not finished, almost. I think we need to be prepared, and a reflection should go on this too. We need to be prepared at the start of this new market, because it will be a global. Say the EU legislation will have a global impact. It is the aim of this EU legislation. Let's not forget it. The aim of the EU legislation, which, as you remember, is three-pronged. So MiCA for crypto assets, pilot for securities, and horizontally on all of this, which means new finance and incumbent security for all of this, DORA. These three pillars go together. DORA is closed, so it's again coming into place. So what is my point? My point is that we have, we have now the pillars of the common market on digital finance substantially in place. Okay, we have a bit of a, let's say, movable terminus on MiCA, but that's it. Then, is MiCA perfect? No, MiCA is not perfect. We have a couple of things that still, in my mind, and in my view, are still, let's say, could have been gone a bit more far. And I'm thinking of NFTs, but how to say, now it's not time to think back on what it could have been done. This is what we have. And my impression is that we need now to work with this at best as we can. And it means then, from a European perspective, this is let's say, a competitive, positive, advantage, looking it on a global scale. And this is the point I wanted to make, the substantial one. Because on a global scale, Claudia will be much more, let's say, precise in let's say, in the painting that I'm doing in a couple of minutes. But on a global scale, the situation is quite scattered and for sure uneven. And it is uneven in terms of, how to say, regulation for the market, protection for investors, say, rules for the infrastructures. I'm thinking of, in particular, on market abuse rules, because we tend always to look at the part of the issuance. But we do know that the most delicate issues are for example, on conflict of interest in the let's say in the intermediaries side, call them exchanges or what else. So, how to say, Europe has a competitive advantage and needs to, let's say, to use it at best. So, and let's say, and the pillars are there. Now, here comes, for example, the what you have highlighted in your works. So again, thank you for the two papers. And why are these crucial? Because both of them in different ways. I'm thinking of the one on ICOs, why do they succeed? and for example, on that, what I'm taking is that we do have scientific strong confirmation of, let's say, of, can I say traditional, I think it gives a negative terms, but substantial market levels, they do work also on the ICO market, which is somehow obvious. This is, one could say, Paolo, okay, you discovered this at 10:21 on this on this 15th of July, fine, but still we do have scientific confirmation on that. This is what, based on that, just to keep it as a reminder, just on that. Just because of that, Consob, when Consob prepared its paper, we did stress very much the crucial, let's say, how crucial it was at that time, and we didn't have any regulation at that time, to look at the information that should go on the market when issuing an ICO, because this is a market level that we know works. So having confirmation today is more than positive, is welcome. Same applies on, let's say, techniques for identifying scams based on machine learning. By the way, for a financial regulator, this is one of the let's say, this is the gray to black area that needs, let's say, needs scientific and even technological support. And on this concept, it's quite exposed. You may or may not know. And Consob is, let's say, is fostering, let's say, expanding the legislation, which currently permits Consob to stop, let's say, internet diffusion of abuses of different kinds. But we still think this is not enough, and we are insisting with Treasury that we need to advance protection in terms of blocking even advertisement of these offerings, which happens currently in some European countries, Spain, France, to give a couple of them, but even in others. We think that we need to intervene at that level, because otherwise still there is a response, but the response is still not at the level of the threat. Okay, let me come back. What is my point? And I'm going to close on this. Welcome to have this research, because this is a fundamental research. And this fundamental research, as always, is the, how to say, is the true food for thought for us, but as well as for the market and stakeholders. So my point with you is, please do continue. And this is for you, Marina, and keep in mind, obviously, Consob will always be sustaining this. We will find ways to help this process. Areas that could be of interest, I think, today, and this is my last point with you, is that, for example, prospects of a global regulation on this, question mark. Not easy, my impression is, but for sure, because we do, well, Claudia will be clear on this, but we see a scattered situation, Europe versus other areas. So point is that need of global regulation, fora for this global regulation, question mark, We have seen 2 days from, what was it, the day before yesterday, FSB coming out on this quite clearly still. But my impression is the need not only, how to say, let's put it this way quite straightly. My impression it's no longer the time of ex post approach by the regulators, how to say, an approach of I told you, quoted and quoted, because we need proactive regulation now. We need to, and this is what EU has done. So this is why EU is different on a global, let's say, scale compared to other regions. The I told you approach, obviously this is for each and every region has been done in a different way, but it's not any longer the correct response. We need to be proactive in giving positive regulation. So the global level of regulation. Second, I think we need to look at cross-domain areas of research that involve embedded security of all of these, or let's say of the crypto market, because we know that security in this market is at a different level of the ordinary cyber and not only cyber security of the financial market, which tends to be for incumbent a centralized one. So then security is provided centrally by a bank on its, let's say, internet banking, on whatever. We do know that in the case in particular of issuance of tokens, if security is not embedded and, let's say, goes to the last mile of the single investor, the risk on even the single token is full. There is no awareness on this on the market. People are not aware that that token is only on their device, unless you have other let's say some architectures of exchanges that somehow provide centrally provision of services. So to me, point is that security is on a different level. I still don't see research on this. Then, in general, last point is that we need to look at the, let's say, all the pillars of the ordinary market, pillars that are, let's say, that needs to be then focused into this new market. So infrastructures, role of intermediaries, safety nets for investors. Seems obvious to say these things, seems a bit of saying obvious things, but still, really the last point, if we want to see this market getting out of the niche dimension into a dimension which is a real dimension, which is not only for scouts that go and look for these, for crypto asset and others, but are asset classes that enter into the offer of the overall market. My impression that unless we focus also fundamental research on these areas, we won't be ready for the time. And we don't have much time because we have those 18 months for the big bang of the European regulation. And we don't have much time because we need to give answers on the, let's say, even on the recent corrections, and avoiding to lose by way of a, let's say, not, let's say, coldly reflected regulation, but only on a reaction by the community of regulators, we risk of having, let's say, a sort of, how to say, overreaction in these areas. And I think for us and for everyone, it would be a pity if we lose this opportunity. Marina, I went a bit too long. I hope I'm still on the schedule. And thank you
perfect. Much. It's absolutely perfect and very insightful. And I'm just going to add one little minor thought. I'm always really surprised fact, there is so much interest in crypto assets, which are actually quite volatile, and the same interest does not seem to be there for equity. I wish that investors liked equity a little bit more in capital markets and investments into companies which have many employees, produced wealth. So I'm traditionally minded, but sometimes I'm a bit concerned that the focus, the capital markets union should go very, very fast, and it's not going as fast as I would wish. But let me hand over to Claudia Guagliano. I forgot before to thank the entire scientific committee of which promotes these seminars, which of course includes myself, Fabrizio D'Ascenzo, Francesco Fancello, Valentina Lagasio, Nadia Linciano, who as head of research department at Consob is always working really hard on this and keeps us on our toes, as they say. Ida Panetta, Maria Antonietta Scopelliti, Donatella Strangio, Tiziana Togni, and Andrea Turi, which since we have a scientific committee, lots of work gets done. And so it's important to remember them. And thank you very much, Nadia, really for all that you and Francesco do. So let's see what ESMA is doing after this very interesting lead-in by Commissioner Ciocca. And as I said before, we have the privilege of listening in to Claudia Guagliano, who is the head of Unit Innovation and Technology at ESMA. She is the person who has really her hands on the pulse of regulation in this area from our European supervisor. Thank you very much, Claudia, for being here.
So, thank you very much. I hope you can hear me well. See the slides already? Yes? Okay, great. So first of all, thank you very much for having me here today and for all the kind words. Thanks a lot, really. Today, I will, the topics that I would like to cover in the next minutes start with the recent crypto market developments and the correction that Professor Ciocca already referred to. And then I will refer to a taxonomy of the so-called stable coins and the recent fragilities, a few words on the initial coin offerings, which is the main topics we are looking at today. And then, of course, I will refer to MiCA because we finally had the political agreement on the 30th of June, and it will still take some time, but it's good to see what has changed compared to the initial proposal. And I will close with trying to do a kind of comparison between what we are doing in Europe, indeed leading and being the first to have a comprehensive regulation on cryptos versus the different initiatives that we have at international level. But let's start with the recent crypto market developments, saying that this is still a constantly fast evolving market, highly volatile and speculative. It has always been the case. And also what has been mentioned already, this is a market that is characterized by an aggressive promotion to the public, including through social media and influencer. These products have always been quite complex, but the complexity has also increased, also in terms of the number of different services that are connected to cryptos. Market still characterized by a lot of scams, but we think that the technology still has the potential to bring some benefits to the financial markets. However, as ESMA, together with EBA and the EIOPA, the other two European supervisory authorities, we issued a new warning in March 2022, and in order to re-alert consumers of the high risk of many crypto assets. We had done it already in 2018, in particular with reference also to the high risk of the ICO, and we thought that this year was the moment to do it again. Now, when we talk about cryptos, we know that we talk about of products. I'm not going to it, but I just wanted to give you an idea of the different the difficulty of doing a full taxonomy on what do we mean by crypto. We go from the so-called stable coins, unbacked cryptocurrencies, governance token, non-fungible tokens, utility tokens, and again, this is still very quickly evolving. But let's look at what happened in the market and at this correction that we are experiencing working in the last months. We had in these charts, you see a quite long-term perspective from 2015 to end of May, end of June data. And what we see is that in the last 6 months, from November 21 to end of May, we had a collapse basically of the market. The market capitalization decreased almost more than 60%. Why is this happening? I think there are a number of drivers that we can identify related to this market correction. The first one is, of course, the change macroeconomic environment, which is affecting crypto assets, but also other risky products in the financial markets. We have a high interest rate high from central banks, expectation of interest rate high, and so a reduced search for yield that had characterized the markets for the last 6-7 years in the very low interest rate environment. Second potential driver is the fact that in the last months we had at least 2 very important episodes in the so-called stablecoin market. So the first one is the Terra Luna collapse in May, and the second one, again, Commissioner Choker referred to it earlier, is the Celsius that now filed for bankruptcy yesterday. So this is another episode, and these 2 episodes really undermine the trust a bit in this sector. And the third point is that indeed we have all regulators around the world that are looking into this market, trying to regulate and to limit the risk in the market, and rightly so, of course. When we talk about cryptos, I said a lot of product, 20,000 crypto assets around. Bitcoin still dominates the market. And what is relevant is that if you look at all crypto assets, we see that the correlation is really high. We see that over the years, the correlations with traditional equity markets has also increased. And the charts that you have on the right show that Bitcoin has a moderate positive correlation also with European equity. It was not the case until today. We see that it is around 40%. During these years where the crypto asset market expanded a lot, we had also the development of the so-called stable coins. Look, we don't want to call them stable coins. In the European terms, we refer to these products as asset reference tokens. And we see that the so-called stable coins increase a lot in terms of market capitalization. And importantly, I would like to highlight that in terms of daily trading volume, the trading volume of Tether, which is the biggest stable coins, compared to the trading volume of Bitcoin, which is the biggest in terms of market capitalization, unbacked crypto asset, we are around 63 billion compared to 8 billions. Again, another major development has been the development of the so-called decentralized finance, which is a quite broad term capturing all the financial markets products building on DLT and on smart contracts. And we have that in general, this market has also decreased a lot with the market correction that we experienced in the last months, but also that the exploits related to DeFi are quite relevant and significant. And you can see this in the chart on the bottom right-hand side, so you can see that the risk related to this market are very, very high again. When we talk about trading, I mentioned the trading in crypto assets. It's interesting to think about the fact specific exchanges where regulated crypto assets are traded, and they are of two different types. We have the centralized exchange, so-called off-chain exchanges, and the decentralized exchanges, on-chain exchanges. Without going into too much details, we can say that the decentralized, what does it mean? It means that there are no intermediaries, so no brokers, and the settlement is done on-chain and is immediate. The main reason why I'm showing this chart is to show that apart from Binance, that is by far the major player, the volume in the decentralized world and in the centralized world are quite similar. You can see these in the tables at the upper part of the chart. I mentioned that one episode in the so-called stablecoin market was quite, let's say, bad for the reputation of this segment of the market. And I would like just to say a few words on the different types of so-called stablecoins that we have in the market. We have the so-called fiat collateralized off-chain stablecoins, where you can see that their balance sheet is comparable to a narrow banks. They hold 100% of their reserves in short-term assets against their liability that are all stable coins. This is the case of Tether, for instance. And what is the main concern in this context? The limited transparency. No one knows what does it mean, what do they have in terms of assets. They say what they have, but there is no transparency. So in moment of, let's say, stress in this market, the concerns increase about what do you have in reality in terms of collateral, in terms of asset. Then we have the crypto collateralized on-chain stablecoin, and the most famous one, the most known one is DAI. And here, these are on-chain, but they are often over-collateralized. What does it mean? It means that if you want to have a DAI, 100 DAI, you need to have 150 crypto assets to back the DAI you are buying. And finally, we have this minor category, still around 17–18% of the full so-called stablecoin market, which are the algorithmic on-chain market. And here, you don't have any reserve in terms of traditional assets. You don't have over-collateralization, but the so-called stability is maintained through open market making and arbitrage. And it's exactly here where we had, in end of May, the collapse of the major algorithmic stablecoin, which is Terra USD, which falls to basically zero in May. The fact that we had this collapse of Terra USD provoked a contagion and temporary to Tether, so the stablecoin, the major stablecoin off-chain, which temporarily depegs in mid-May, but then recovered. What is interesting and important to say is that from this event, there was no contagion to the traditional financial market, meaning that the crypto world is still in a way separate from the rest of the world. Of the traditional financial market world. But moving quickly to the topic of today, so the ICO, I will not spend a lot of time because we have two very interesting papers that I'm looking forward to hear. Just to say that the ICO, as you know, peaked in 2017 and then lost a bit of popularity. And since 2018, the crypto issuers have tried to use also other methods to finance, to fundraise, including private pre-sale, airdrops, and initial exchange offers. Why is this happening? Why did it happen? For a number of reasons, including the increased regulatory pressures from securities authorities into initial coin offering, including ESMA, that in 2017 had already alerted the investors of the risk related to initial coin offering. And the risk and challenges, and again, the two professors that will talk after me will expand a lot on this, are from the supervisory perspective, the absence of regulation, which creates opportunity and incentives in the ICO world to launch scam, and also the information asymmetries between the project promoters and investors. There are no disclosure requirements so far, and unclear legal obligation to investors is not assured that what are the rights of the investor. And finally, the risk of money laundering is high. And again, looking forward to hear these two papers, the first one on the key factors driving the success of an ICO, and the second one is also very, very interesting on what could be, how machine learning can be used to predict the ICO scams. Final regulation. In all this, in light of everything that I said so far, risk because there is no regulation around in particular, we now will have MiCA. It will take still a bit of time because I said the political agreement was reached on the 30th of June. Now we have all the technical work that will continue until probably September. We expect to have a vote only in November on the final text, and then probably the publication in the official journal will not happen before 2023, probably already in spring. This means that we will need to wait until 2025 to have really MiCA in place. But again, we think that it's very important that we try to implement MiCA as soon as possible, because in the European framework, what determines which rules you can apply and how well you can supervise is really the legal qualification of an instrument. And so we had for those crypto assets that qualify as securities, MiFID financial instruments, that the full set of financial securities rules apply, MiFID, prospectus, CSDR, and so on. And for this, we the Commission and we have now this DLT pilot that has the objective to facilitate a bit also the development of this technology. Then we have a second category, which are the crypto assets that qualify as e-money, and for this the e-money directive apply. But we have, as I showed in the previous slide, a full set of other crypto assets that go from the payment, utility type tokens, so-called stable coins, and other that are completely unregulated. And so there was really a very relevant and important regulatory gap, and a new framework was necessary. And that's why we have MiCA. Without going into the details of what is in MiCA, I just want to mention a couple of new things that were not in the proposal and that we can find in following the trialogue. The first one is product intervention powers that have been assigned to ESMA and EBA to prohibit and restrict the provision of services by crypto asset service providers or the distribution and sales of crypto assets. This is, as we know, a very powerful power that has been given to the supervisory authorities. Then ESMA will have coordination power, and so we require information sharing and regular reporting with national authorities on the supervision of significant crypto asset service providers. Third point that I would like to mention is the new policy mandate related to environmental issues. So ESMA will need to write regulatory technical standards, methodologies, and presentation of information related to the environmental and climate-related impact. On non-fungible token, Commissioner Ciocca already referred to that. Non-fungible tokens at the end are excluded from the scope, except if they fall under existing other crypto asset categories. And the Commission will be tasked, the European Commission will be tasked to assess the need for a new legislative proposal, ad hoc legislative proposal for non-fungible token. And finally, as an EBA, we'll need to issue non-binding opinion on the legal qualification of crypto asset and on the issuance of and on the application for authorization of issuers of asset reference tokens, which is the word that we use for the so-called stablecoin. So MiCA is really establishing a comprehensive regulatory framework for crypto assets. But again, as mentioned by by Commissioner Ciocca, if it's the full, all the regulators around the world are now looking at MiCA, at risk in crypto assets, and it's obvious that now MiCA becomes the standard for all the other regulators around the world. UK, US, they are looking into cryptos, they are discussing several ways to address the issue, but at international level, FSB, IOSCO, BCBS, we are all looking into this topic. The FSB, the Financial Stability Board, from the financial stability perspective, and it's probably our assessment is that financial stability risks are not so high, in particular in light of the recent market correction, but also because the exposure of traditional, let's call them traditional financial entities to crypto is still limited. IOSCO is looking into this from a market, mostly from market integrity and investor protection perspective, and they are very much, all the regulators are very much now looking into MiCA, how this will apply, and how maybe at international level we could have some principles that apply at global level in order to address the risk on cryptos. And with that, I give you back the floor, Marina. Thank you very much again for inviting me here today.
Thank you very much, Claudia. I will hand over now to Professor Panetta, who's also full professor of banking and finance in Sapienza. So the floor is yours, and thank you very much.
Thank you, Marina, for the word. Thank you, Claudia, for your insightful presentation, as usual, and for introducing to the theme, and also to update us on the latest news on regulation. And we are proud that the EU proposal can be the benchmark also for the other areas. Now, let me lead you into today's research discussion, and let me say that the two papers chosen are undoubtedly a contribution to the literature on initial coin offerings, as anticipated from Commissioner Ciocca and from Claudia too, and they deep two different points of view. Let me recap some organizational issue. The paper presenters have 20 minutes for their presentation, and then we leave the floor to discussion for at least 10 minutes. And then we can start with the first presentation. The first paper is Initial Coin Offerings, Why Do They Succeed? It's a joint work of José Campino, Ana Brochado, and Álvaro Osa. And today is presented by Professor Ana Brochado from Lisbon University. Thank you, Hannah, for being with us today to share with us your results. If you are ready, okay, the floor is yours.
Thank you.
I think so.
Yes, I'm just trying to share the PowerPoint. Is the PowerPoint now in your screen?
Yes, it's our screen. If you move to the presentation mode, we can see enlarged.
So, perfect. So, good morning. I'd like to start by congratulating Consob and the Sapienza University of Rome for this event. And I'd like to thank the opportunity for presenting our work today. It's an honor to be here, presenting the work entitled Initial Coin Offerings, Why Did They Succeed? So my work on initial coin offerings that started in 2018 with a snapshot of initial coin offerings. At that time, I was working as senior economist for the Portuguese Security Commission. I wrote a paper that is a systematic literature review of all the literature about initial coin offerings. And then I have 3 papers on success, the financing success of initial coin offerings. And one of those papers is the one that I'll be presenting today. And I'd like to start the talk with the question, when Lambo? So when Lambo is a question that spreads in the online communities about cyber assets, is a question of when a token investment is going to pay off the investor can buy a Lamborghini. And I believe that there's a new money subculture within the token space. So initial coin offerings are more than technology and finance for investors. They illustrate a dream of any ICO investor to make a large amount of money in a short time. And that is a challenge for sure for regulators because it includes a lot of bias on investor behavior. But let's start with the talk. So initial coin offerings are a new way to finance new ventures. They are like crowdfunding an alternative finance instrument. However, they are allowed to finance specific blockchain projects. They have the online distribution channel. And today there is a development of an ecosystem that I believe was discussed today in the first talks, this ecosystem and regulatory issues. They allow to project finance in the early stage.
Sorry, Anna, for interrupting, but if you are moving on different slide, we are still on the first one, on the cover.
Oh, I'm so sorry. How can I do? Because actually I'm moving. Does this move? No.
No, maybe you have shared a different screen, another screen. If you had to, you have shared the wrong screen.
So we did a test, but we only tested the first slide. So I do, when I share, I have desktop window, right? And then I have window. Maybe if I share the entire screen will work? No, not sure.
Maybe it will work.
Let's see, entire screen. No.
Because we see the you start the presentation mode, but maybe it will be in another window.
Let me see if now, and now, is it in the screen? No.
Not yet.
I don't know how to do that.
Maybe you can move.
You can share your presentation, Anna.
So when I have here in a screen share, I can share the screen because when I have the PowerPoint, no, it does not work here. No, it has nothing to do with this.
Okay, we see another presentation on research methods. I can ask Francesco if we have a copy of the presentation. Maybe I can assist you and project the slides.
Unfortunately, no, we don't have received.
Okay.
I can email in a minute.
Sorry for interrupting you, but I suppose
no, that's perfect. That's perfect. I'm
showing the data since the reconstruction of literature and also the model. It's important to be shared.
I just emailed to Francesco.
Maybe in the meantime, we can.
I can continue so without the presentation if you agree. So let me only look to mine. It's okay. So I was briefly presenting the characteristics of the initial offerings. They have the white paper that is important to decrease information asymmetry. Another advantage is the democratization access to entrepreneurship. However, there is also a dark side, the zombie tokens, the cybercrime, and all these scams. So, and this is the issue for any regulators. Now I have a graph. If you could assist me to have the presentation. So I prepared a graph that has an idea of the investor attention towards the ICO. So what I did was to collect Google Trends data on the web searches as regards initial coin offerings. And I really found what was identified as that the top searches happened in the late of 2017 and the beginning of 2018. And I'd say that this might be associated with the highest ICOs forever on the market. Francisco, have you already received the presentation?
Just received. I'm trying to open it, and in a few seconds I should be able to share it.
Thank you. So, and then in the next slide, I briefly present the results of the systematic literature review on ICOs to make sure that I could add where this paper is located. So in this systematic literature review paper, we collected all papers published in the literature from all fields. And initial coin offerings received attention not only from economics, econometrics, and finance and business, but also from the social science like the law and also technology and so on. And this paper aims at answering a specific research question. What are the main success factors of ICO project outcomes? Now, it would be really useful if I could have that.
Francisco, if you have troubles, you could try to forward the presentation to me.
Yes, trying to. Yes, I'll.
Okay.
These are things that happens when we are not recorded, you know, when we are directly online.
But
don't worry.
Actually, we did a test, so but yes, we only did a test for the first slide.
It's the same. It's the same. I just finished a conference, and it happens everything. So it's normal. It's normal things that happens when we are on direct mode. So just to give some spicy to the day.
Yes, actually, in Portugal, we use the Zoom platform.
Yes. But it happens also with Zoom. Don't worry. We use the Zoom one, the Meet one. Something sometimes goes wrong, and it's nobody's fault, you know.
And actually, yesterday I finished a summer school in South Korea on online, and it works well. But I promise that I will then shorten the presentation to reach the.
Don't worry, Anna. Don't worry. It's not a problem. We have some.
Okay, Anna, I'm sharing your presentation.
Oh, perfect.
Thank you, Nadia.
So please, you will tell me.
Okay, so
yes,
how I can move forward.
Okay, yeah. So if you could move, so this is the slide about the when Lambo when I started. Then this is the description, this is the search data, and then
Okay, I think here we are. Okay.
Here we are. So what are the main success factors of ICO project is the theme of this presentation. And I'd like to start the literature review by summarizing the main conclusions that we reach in another paper. If you could move, please. That is a systematic literature review and collect data for all types of information. So this is a semantic network analysis based on abstracts, and the bubble that is on the left bottom side is linked with the theme that we are addressing today, that are the success factors. So here, what if could move. So just to brief what the literature has studied about ICOs. In the next slide, we have the ICOs are a new wave of investment that completely create a revolution on the landscape of entrepreneurship and innovation. The team investors collect data, analyzes the papers that relate investors to all information asymmetries in decision-making and uncertainty that potential investors face due to the relatively, at least till now, unregulated ICO space. Next slide has two other teams. Many papers relate with the blockchain into perspectives, the blockchain technology, and then the blockchain ventures and this type of projects. The team tokens includes all papers that describe the type of tokens that are available on the market. It is also linked to the new classification of taxonomy from ESMA. It's also considered that it might be used to diversify the portfolio. Next, in the next slide, we have other papers that talk about the market, and the literature has focused both on the primary marker, I'd say the token offering, and then on the secondary market that is linked with the liquidity of these assets for the investors that attracts also. And here there are many papers in the law perspective, that regulation, that they look for a need for efficient regulatory environment, both to protect the participants in financial investments and also to promote financial inclusion by promoting, additional source of investments for the enterprises. In the next slide here, we have the two final themes. So there are papers included in all these. Researchers from law have discussed many web tokens are securities according to the national legislation. That was the talk 4 years ago when I was working for the Security Commission. And another stream of papers look for the success determinants of the ICOs campaigns. And this is the target of this study. So in the next slide, I have the two theories that guided our work. First of all, we classified and view an initial coin offering as a venture operating in an open access model. ICO ventures have several interactions with different agents that can change even the project perception, like the website where the ICO is published, the experts who classify the project and offer ratings, and all this system works before, during, and after the financing campaign. In the next slide, we have the second theory, so that is the signaling theory. That is the main core theoretical background of this study. So the ICOs market is described by enormous information asymmetries between the promoters and the investors. And this is identified in the signaling theory as the information asymmetry problem. So the information theory maintains that there are signalers, receivers, and signals. And the signals in an ICO project might be patents, the white paper, the quality of the source code published in GitHub, or an ICO rating. And in the next slide, we came with the literature on success factors. So we identified and classified the success factors in 4 groups based on previous studies. We innovated by combining all these factors because some of them were specific to only a few or 2 papers. So the first is the social networks, to being present in the Twitter and GitHub, the repository of code, the activities in social media networks related with the project itself, the campaign, the characteristics of the campaign, the token sale, the period, the existence or not of a press sale or bonus, the token price, the financing thresholds, the soft cap or hard cap, and also the accepted cryptocurrencies for the transaction. Other characteristics are linked with the project, the geography, the industry, and this paper will focus in a specific industry, the white paper, the existence of not of a secondary market. And finally, and one of the most important is the team, the human capital, the team characteristics, the size, the professional experience, the educational background, the managerial experience, their social media activity, and so on. So in the other papers that we wrote, we focus on this in the team. So we came with two hypotheses. The signals provided by the project promoters to investors in the open systems relationship contribute positively to the success of the campaign. And the second hypothesis is projects that provide higher levels of quality information are more successful, those that offer more transparency for the investors. And then I can go in the next slide to describe the methodology for this project. So we use it secondary data. So we managed to bought ICO Bench premium subscription and download automatically the data about all projects available. We also collected manually data for each project on Twitter, white paper, the ICO website, and also the LinkedIn. In this project, we analyze it only a part of the data set that we collected that is larger, and we analyze it the projects that were developed in the banking or financial sector. Might be, for example, a new blockchain, a new platform for payments in a casino. I mean, this is an example. We have different types of dependent variables and use two methods, the robust regression and the logistic regression to count with different types of dependent variables. Next slide starts presenting the variables. So we adopted 4 dependent variables, the logarithm of the total capital raised to account for projects of different sizes, the achievement or not of soft cap and hard cap. Not all projects have these thresholds, and then the existence of a secondary market. In the next slide, we have the description of the project variables. So the disclosure of the team members in the white paper, the technicity of the white paper, the word count of the white paper, and the number of countries where the project was restricted, and then the project region. So these are the project variables. Some of them were collected manually, as in the white paper. We'll open each white paper and collect the data. Then for campaign variables, we have the existence of the pre-sales, the bonus scheme, the token price, and then the price of the main cryptocurrency, Bitcoin and Ethereum. Most of these projects use Ethereum, are Ethereum-based projects, and number of currencies accepted by the project. In the next slide, we have the social network variables, the existence of a Twitter campaign, the number of Twitter followers of the campaign, the number of tweets, the existence of a GitHub account, the existence of the code prior to the ICO launching, publishing the GitHub account, and then the existence or not of a website for the ICO. Then we have the team variables, the logarithm of the number of elements of the team, the number of advisors of the team. A team usually has the promoters, the team, and then the advisors, and then the team members' connection on LinkedIn. So we collect this variable manually. Then I believe I can present the results. Here they are in the next slide. So instead of having here all the regressions and the statistics, I've tried to have in one slide present the main results. So we concluded that the ICO success, and here success is linked with success in getting financing in the primary market, is mainly associated with white paper. So the disclosure of the team in the white paper, a detailed white paper, are associated with success. So they reduce asymmetries, ensure transparency, and also link with the projects that get financing. Then we concluded that third parties has all these companies in the ecosystem that having the expert rankings. We concluded that the ratings are also associated with the financing. So here is the variable rating. Then we concluded that shorter campaigns are more successful. So there is a negative relationship between success and duration of the campaign. We concluded that projects that have the higher token price are more successful, which might be used as the price as a cue of the quality when there is uncertainty and informative asymmetry. We concluded that is also the evolution of the cryptocurrency market and the value of the cryptocurrency has an impact on the success of the campaigns. And then looking for the promotion of this project as it is done mainly online, we concluded that the successful campaigns are associated with the existence of a Twitter campaign and Twitter followers. And that might be also linked because investors trust on their peers, and this in social media campaigns, we have this type of also relationship. We concluded that one variable that is of utmost importance are the team members. And here we concluded that there are differences between traditional entrepreneurship and these ICOs. In traditional entrepreneurship literature, a small team means success. And here we conclude that larger teams are linked with the success, maybe due to the complexity of the projects. And we also concluded that for the importance of the existence of a secondary market to give trust maybe on the first and on the financing. So I believe that I briefly summarize here the results of all the regressions and all the models, and I may come with the conclusion in the next slide. So so we concluded that the signal of So we concluded first the quality signals provided by the project promoters to the investors in the open system relationship contribute positively to the outcome of the project. We confirmed that the signal of expensive tokens complemented by bonus scheme attract investors, as does the existence of a larger and heterogeneous team that capable of producing positive results when compared to small and homogeneous teams. We concluded that projects that provide higher levels of quality information are more successful. Projects that disclose the most information in the white paper and have comprehensive documents are more likely to succeed. So the teams and projects, ICO projects that inform stakeholders during the social networks and are active during the campaign to keep the investors engaged, measured by the number of followers, are more likely to achieve good results. And this is good because it means that when the information symmetry is reduced, projects are more likely to succeed. And I came with the final conclusion. So the success factors were divided in the perspective of this study in 4 groups: the campaign, the project, the team, and social networks. And they were as quality signals for the investors. The ICO market is, of course, characterized by strong information asymmetries due to the technological complexity. It seems that for investors and for the success of the campaign, the results reveal the external ratings and the white papers are important. And in the external ratings, we have here a third part in the ecosystem. It seems that there is association also with cryptocurrency valorization and the token prices with the ICO success, that's Q of higher price, higher quality. And we concluded also for the importance of the social networks, including also the peer-to-peer communication and the importance of the team, human capital. So what you are planning to do now? We are now analyzing the full data set that has 5,400 papers from all sectors, include macro variables. And we also have a data set with all the members that are on these projects that are 200 and 1,000 people, advisors and team members, and we intend to study corporate governance issues, the network analysis. So this is our ongoing project. Thank you for the help for presenting the paper, and please accept my apologies for the technological issues in the beginning of the presentation.
Absolutely, thank you, Anna, for having shared these interesting results. And now I want to ask to Professor. Sorry, I can't see you now. Okay, yes, I am. Now I want to invite on our virtual stage Professor Valeria Stefanelli from the University of Salento, who has made herself available to act as a discussant of this interesting paper. Valeria, if you're ready, the mic is yours.
Yes, thanks, Aida. Can you hear me? Yes, fine, thanks. Good morning, everyone. Let me start by thanking the conference organizer, so Consob Authority and Sapienza University of Rome for this kind invitation at this important webinar. A special thanks to Professor Marina Brogi and to Nadia Linciano from Consob for this opportunity and meeting. I also wish to express my congratulations for this organization of this important webinar about an interesting and challenging topic linked to digital finance area. So it is a pleasure to discuss the paper Initial Coin Offerings, Why Do They Succeed, written by Anna and Jose Campino and Alvaro Rosa. And for this task, I have prepared a presentation that I'd like to share with you.
Let's see.
Can you see the first slide?
Yes.
And
yes,
the second one?
Yeah.
Okay.
Yeah.
Also the second one, you can go on.
That's fine.
Fine, thanks. Thank you. So first of all, I point out that the paper is already published in an important journal, which is Financial Innovation, edited by Springer. And so for this reason, I will limit myself to highlighting the main results and the policy and managerial implication of the paper. I have some points on my agenda that I would like to highlight. Just a summary of the paper, topic, relevance, novelty, and theoretical contribution of the work, content and discussion divided into two parts, main aims and secondary aims. The paper aims to answer a main question, which is which are the success factors of ICO's projects? To answer this question, the authors use an econometric approach based on regression analysis like ordinary listed square and logit model, and also a robust regression to test the results. The sample consists of approximately 500 ICOs projects in the banking sector, and the data used are information from white papers, information on project teams, on social media coverage, and cryptocurrency trends and evaluation. The source is ICO Bench, as Anna explained to us. The paper points out that information disclosure quality on white paper impacts ICO project success, and also cryptocurrencies trends influence the success factor of ICOs. So I would like to highlight some innovative aspects of the research and points of interest for the financial industry. The paper deals with an innovative topic linked to project financing, on which the attention of the academic debate is developing. Digital technologies in finance favor dynamics linked to financial inclusion and entrepreneurship. In essence, greater financial development could foster economic growth by improving the efficient capital allocation. The literature also discusses the destination of financial benefits like financial inclusion or support for aggressive entrepreneurship. Some results of the paper notes that a barrier to development is the lack of information between proposer and investor, useful for evaluation, innovative and deserved proposals. So it is essential that the ICO sector has policy indication and to adopt adequate tools and information on the project to allow investors to have adequate knowledge on the projects to be financed. These results, I think, support the role of regulators, as Paolo Ciocca and Claudia Guagliano said. So the paper is exhaustive and clearly written. The research question is interesting from the perspective of financial operators and regulators. Structural success factors for ICOs, categorization of fundraising option through ICOs. The question appunto is, do groups of factors which contribute to improve information and financing performance exist? About literature, the theoretical background sustainability includes the main advancement in the fields, considering the majority of the best knowledge up to time. Some relevant research is missing, which would look at regulatory and supervisory issue, since ICOs suffer from the same control issues as financial technologies. Some studies went behind this threshold, analyzing financing tools in comparison, as well as regulation matters and solution. For example, Bellavitis and others, 2029. Broadly speaking, this is a central issue regarding the fintech world as a whole. So about the results, the paper explains very well the managerial and policy provisions linked to the quality of information on ICOs to avoid fraud and crime. The analysis should be conducted on a multi-year time span with fixed or random effects panel in order to better identify the evolution of success factors of ICOs. In this case, analyzing time series data is more appropriate than a cross-section analysis, which is not able to capture exogenous factors or structural phenomena. Conclusion, as for the implication, they may deserve a stronger focus, as already mentioned, in terms of supervisory issues, although implications for policymakers are quite well developed. Limitations, on the other hand, could become a useful starting point to examine the phenomenon on the other perspective, such as the use of some variables, like soft cap, which is a dependent variable in one of the logic models in the paper, as a dummy variable impacting on the raised capital. Secondary hints, since some selected variables were discarded for collinearity problem from the econometric model, a good solution could be to test new variables to be combined with them, involving some related to open banking innovation tools. Another point could be test the interaction in the empirical analysis, interaction of fintech sector with other industrial sector. So I completed my discussion. I congratulate the authors with this publication and thank you for your attention, and hope I was in time.
Thank you, Valeria, perfectly in time. I don't know if Anna wants to add something to reflection of Valeria.
I only take the opportunity to thank all the comments and suggestions, mainly considering the time series analysis and the other types of variables that will be of utmost importance when we analyze the full data set. So thank you for all the comments and the suggestions. We are grateful for.
You are welcome.
So thank you both, and we move to the second paper presentation. It is entitled Identification of Scams in Initial Coin Offerings with Machine Learning, and is a joint work of Bedil Karimov and Piotr Wojcik, both from University of Warsaw, if I'm right. We invite the Professor Piotr Wojcik to present the research, and if he is ready.
Yes, I'm ready. Thank you.
Okay.
Can you see the screen? Can you see my presentation changing slides?
Okay, perfect.
Do you see all the slides, right?
Perfect.
Okay, so hello, everyone. Thank you for the invitation. It's my great pleasure to be the guest on your seminar. As you said, it's the joint work of me and my former master student, Bedil Karimov. The paper is already published. As I have limited time, let me go through the slides. So basically, the objective of the research is to try to classify ICOs as scam or not scam based on features which are known ex ante before the project is finally ongoing, right? We assume that it may happen that there are some nonlinear relationships between the factors of success and the dependent variable. That's why we assume using a linear model might lead to incorrect conclusions. And nonlinear models may better reflect true relationships. However, we don't know the shape of relationship in advance, and that's why we try to use some tools which are flexible, which adjust to the data and catch nonlinearities, are able to unhide any shape of relationship. We use machine learning tools. And as I said, the paper was published last year in Frontiers of Artificial Intelligence. You may find it online. It's available in open access. So of course, the motivation is increasing popularity of crypto assets. That's the graph of total market capitalization at the point at which we were writing the paper. As Claudia Giuliano discussed before, there was a collapse afterwards. Here the market capitalization ranked above $2 trillion, while now it's on the level below 1 trillion in here. But anyway, we are still, many people are still interested in crypto assets. What is more, in case of initial coin offerings, there is huge uncertainty about their success. There are different definitions of success, but for example, in one of the papers, Dowlot and Hodop, they observed that successful or initial coin offerings that finally moved to trade were just 8% share of all which were considered prior to trading. And out of those that finally moved to trade, again, only share was successful. So it's very important to be able to limit the risk of investing in things which do not finally get successful. So let me shortly describe the novelty of our approach. So basically, we use a wider definition of a scam, based on updated information from the net. We base our analysis on the data set provided by Fallenbach and Frattaroli from the paper published in 2020. But in their case, they defined a scam in the following way. So if the amount of the hard capital raised exceeded $1 million, they considered the ICO to be successful, otherwise a scam. So it was just based on the hard capital raised. While in our case, using the same data, we defined scam in a different way. So we checked all the social media websites information about existing ICOs which were in the data set, and if they were still active at the moment of writing the paper, then we assumed they were not scams. While if they didn't exist anymore, if there were no activity in social media, or if they were delisted from listing platforms, we assumed that these were scams. So in our case, the data set was slightly balanced. So we had, according to this definition, we had about 42% of scams, while 58% of ICOs were not scams. The other novelty was the use of flexible machine learning algorithms, which enable us to discover hidden nonlinear relationships. And in the end, as those machine learning tools are usually black boxes, we also applied explainable artificial intelligence tools to enhance the shape of relationships and to rank predictors in terms of their predictive importance. So we tested 3 research hypotheses. The first is that the characteristics of ICOs, which are known ex ante, so before the offer comes onto the market, help to predict that this is a scam or not. The second hypothesis was that nonlinear machine learning algorithms are more accurate than traditional linear models, mainly related to logistic regression and its extensions, its regularized extensions, as nonlinear tools capture non-standard relationships. And what we also assumed was that it's crucially important which kind of technological background is behind the offer, right? So if the code is available, if there's a white paper available, if the ICO uses a blockchain, or if it uses a decentralized platform. Okay, so what about the methodology? So we applied some feature engineering at the beginning. So we omitted non-informative features or those which are highly correlated with one another. We also limited the number of predictors to those which were really known ex ante before the offer was finally run, right? So we tried to avoid information leakage. We tried to avoid using predictors which are somehow related to the success definition. That's why we didn't use all the features available. So in the end, we used a set called all features, which consisted of 53 categorical predictors and 23 numerical predictors. And we called them all predictors in here. But we also applied some manual feature selection, feature filtering. So based on the individual relationship of every feature with the outcome variable, we selected some categorical predictors and some numerical predictors. Those categorical were filtered based on the Kramer's V statistic, and we finally limited them only to 18 predictors. While in case of numerical predictors, we used one-way ANOVA, and in the end, we were left with 10 predictors. So this limited set of features was called selected features. As far as the performance measures are concerned, we use a wide range of metrics: area under ROC curve, accuracy, sensitivity, which is sometimes called recall, specificity, precision, F1, which is a metric that is a harmonic mean of sensitivity and precision. So it takes into account both potential errors or misclassification problems which may happen, and in the end, balanced accuracy, which is the average, non-weighted average of sensitivity and specificity. As far as the models are concerned, we use the logistic regression as our benchmark. Then we use regularized extensions, so lasso type enriched regression. We also applied a support vector machine with different kernel functions, with a linear kernel and polynomial kernel functions. And in addition, we used some tree-based models which are also very flexible and allow to catch nonlinearities. These were random forest, XGBoost, CatBoost, and light GBM. We split our data into two parts, training and test data. Within the training data, we applied cross-validation. So we had some kind of validation, additional validation sample inside the training set, and we ran estimation on two sets of variables, all and selected as mentioned before. Whenever we had to tune hyperparameters, we used F1 as a metric which was maximized. And of course, we also applied those Xi tools to explain our models. And from the Xi tools, we used two methods, which were model agnostic. So permutation-based feature importance to be able to show the ranking of features in terms of their impact on the model performance in the same way, independently of the model time applied. And to explain the shape of relationships, we used partial dependence profiles, which show the, let's say, ceteris paribus, the impact on a particular predictor on the probability of a scam in our case. In case of data, we use the same data which was explained in the Fallenbrach and Frattaroli paper. So it included 305 completed ICOs with 136 features, but limited by us. Now the data, the information includes many characteristics like the start and end date of the funding, the amount raised, the amount of tokens issued, price of a token, platform use, the information about the team, about the white paper, some dummy variables if there is a website available, if there is a GitHub page, there is the industry categorical feature, the token type, token standard, also some legal aspects of the ICOs, like whether the project takes appropriate compliance measures like know your customer or anti-money laundering, legal form, and so on and so on. So all those variables were taken into account. Okay, so the next slide shows numerical results. I won't discuss them in detail, but let me only tell you that these are the results on the validation set in here. So logistic regression does not perform well. Its F1 score is the lowest here. And we observed that in case of logistic regression, it helps to use a model on a preselected feature. So if we remove some features which are not important at the beginning, then the model improves. However, even if we apply some automated feature selection methods like regularized lasso or rich regression, they perform better than the basic logistic regression. However, still they produce highly imbalanced prediction accuracy. So they have much higher sensitivity as compared to specificity, which means they better predict scams than non-scams. Of course, it might be considered as a good result, but it's also like sensible to have a model which performs well on both sides of the problem which we try to model. Much better results were obtained by the support vector machine model, especially with the polynomial kernel, which in fact is highly nonlinear. So it somehow suggests that nonlinearities might be behind the relationships in here. And best among the best models, which perform best in this case, we identified the XGBoost and also a random forest. So let me jump to the slide showing the Ariane rock curve, the rock curve, the full rock curve. We compared rock curve for selected models. So for random forest, for XGBoost, for logistic regression, which is our benchmark, and also for SVM with polynomial kernel. And you can see that all the models seem to be better than a logistic regression, right? For all of them, the rock curve seems to be most concave, and it seems to be the best for the random forest. The blue line seems to be most concave. Here, however, the lines of random forest, XGBoost, and SVM seem to intersect with one another, which seems that some models are better in some parts of the data, so they identify better scams which have or ICOs which have a high or low probability of a scam. So taking into account the results in the validation set, we selected two models as the best models for our analysis. So XGBoost and Random Forest, both based on selected predictors. The test data results are not as high as in the validation sample, but they still confirm that we can quite accurately predict ICOs with accuracy of about 63–65%. Still nonlinear features, still nonlinear models perform better. They show higher F1 statistic, higher F1, higher F1 and balanced accuracy statistics. Again, the SVM with polynomial kernel seems to be consistently performing well, but as I said before, not as well as in the validation set. So in the end, taking into account all the results, we observed that nonlinear models are superior in identifying scam projects, which somehow supports our research hypothesis. What is more interesting, I hope, for you is the feature importance or variable importance. So we measure a variable importance for two best models, for XGBoost and for Random Forest, and we measure it with the so-called permutated feature importance metric, which shows how the value of the error increases if a particular feature is randomly permutated in the data, right? So if we just change the feature into random, and looks like in both models 5 out of 6 features which are most important are the same, maybe in a slightly different order. But those include the length of the crowd sale calendar days, number of total tokens, the share of tokens offered ex ante to the team and to the investors in pre-sales, how we can interpret these results. So basically, the importance of the length of the crowd sale shows that the time frame for gathering the funds, as well as the time provided to investors, is really critical in the success of ICO. Investors also seem to care about what is their share in the project, which is very important for the future decision whether they invest or not in this, whether it's successful in the end or not. In addition, among the features, also the use of the decentralized platform in the project and the availability of the smart contract code, especially in the XGBoost, are important determinants of scams. Furthermore, we also notice the importance of the total number of tokens, providing a discount during the crowd sale, and having minimum soft capital. So let me jump to the next slide, which shows partial dependence profiles, PDPs, for one of the features. So basically, we evaluate the shape of relationship between the probability of a scam, which is on the vertical axis, and the value of a particular predictor for 6 most important predictors identified in our best models. We compare those shapes predicted by XGBoost and Random Forest, but also show the benchmark model, so logistic regression. This is the red line, and green line shows the shape based on SVM model with polynomial kernel, which was also performing quite well. So the first graph shows the relationship between the probability of a scam and the length of the crowd sale calendar days in here. And you can see that all the models show a negative relationship between the length of the planned length of the crowd sale, this planned, so known in advance, ex ante, and the probability of a scam, right? So it means that the longer the crowd sale lasts, the lower the probability of a scam is, which to some extent means that the longer the ICO is offered to investors, it seems like the safer the investment is. However, you can see that XGBoost, which is the violet line, and Random Forest, which is the blue line, show clearly non-linear relationship, right? They show that there is a kind of drop. So the probability of ICO being a scam is very high for very short offers, let's say up to 2 weeks. And then it decreases sharply, right? So if the ICO is offered very shortly, there's a very high probability that it's a scam. And then nonlinear models do not show any difference. Like if the length of the crowd-side days is longer than, let's say, 30 days, then it doesn't matter how long it lasts. It's more or less the same, and the risk is the same. The next two slides show the relationship between the centralized platform, yes on the right, so having a decentralized platform on the right and not having it on the left, and the smart contract code, again, having a smart contract on the right, not having it on the left. And you can clearly see that if there is a decentralized platform, or if there is a smart contract code, the risk of ICO being a scam is lower, and it's consistent among all the models, irrespectively of whether we use the linear or non-linear relationship. Then we have the same graph for number of total tokens on a log scale, which again shows that the risk of scam decreases with the number of tokens issued. So the more the tokens are issued, the lower the risk of being a scam. But still, the relationship seems to be highly nonlinear. So if we apply logistic regression, which shows this red line, we may not model the relationship well, as basically, in fact, according to nonlinear models, there are in fact two levels of a scam. So if the number of tokens is relatively low, up to, let's say, 17, 18, then the risk is quite high, but then it drops sharply and stabilizes if the number of tokens is above, if the total number of tokens in log terms is above 20. Let's jump to the next slide. It's also very interesting. It shows the relationship between the risk of a scam and share of tokens for the team offered ex ante. So logistic regression, the red line, and SVM, which is the green line, both show positive linear relationship. However, a random forest, the blue line here, shows a kind of U-shaped curve, right? Where the probability of a scam is quite high, both for small share of tokens offered to the team, but also high share of tokens offered to the team. So it's safer if the share of tokens offered to the team is not too high, but also not too low. Okay, let me jump to the last PDP graph. So here we show the relationship between the share of tokens offered for investors in pre-sales, which is also known ex ante, and the risk of probability of a scam. Again, nonlinear models, so random forest and XGBoost show clearly nonlinear relationship. They show that if the share of tokens offered to investors is small, below 10%, the probability of scam is very high, right? Relatively high, let's say, above 45%. While if the share of tokens offered to investors is above 10%, the risk sharply decreases, right? There is a huge drop in risk, and then it's much lower and doesn't depend on the whether the share is mediocre or high. While again, linear models are quite are showing not much different shape, which might be far from real relationship. So to conclude, we confirmed all three research hypotheses. So ex-ante characteristics of ICOs allow to distinguish between scams and not scams with a relatively high probability. We confirmed that the nonlinear machine learning models are superior. First, they are more accurate, but they also better explain the shape of relationship. However, the superiority was much higher. So the difference between nonlinear models and linear models was much higher in the validation sample. It was not that wide in the test data. And last but not least, referred to the third hypothesis which we tested, we noticed the importance of technological capabilities, which are also the important factor of success of ICO. Although it was not obvious that all technical aspects are important, we show the positive relationship between the availability of the smart contract code and using a decentralized platform. And we hope that the patterns which we found may help investors to identify reliable ICO projects and make rational decisions. So thank you for listening. I hope I didn't make it too long. Let me stop sharing my screen.
Okay, thank you, Piotr. Thank you very much. I don't want to stall more time, and I give the mic to Paola Cerchiello from University of Pavia, a colleague of us that help us to discuss this interesting paper. I give the floor to you, and then I will return to you.
Many thanks. Can you see my slides?
Perfectly.
Okay, so many thanks to everybody for organizing this such a nice webinar, for inviting me, of course. I think that putting together all these different perspectives, so from scholars, regulators, on such a peculiar type of a business that rise in the last years in the financial technology, in the new financial technology context is really valuable, important, because we all know that we need more research in this, and we need to dedicate, to allocate time and efforts in trying to understand as much as possible the characteristics of this such a huge and unique scenario. And so from this point of view, these two papers that are similar somehow but also different, because they put emphasis on two different aspects. The first paper was more devoted on understanding the drivers, also from let's say more standard point of view, by using linear regression or variation of classical linear regression. Instead, in the second paper, the authors try to investigate the huge plethora of machine learning algorithms, especially nonlinear ones, with the idea of understanding, again, the drivers with a specific point of interest that are scams. So I maybe can skip some of this because we have been talking about initial coin offerings in the last 2 hours, so no need to add more on this, even if I prepare a few slides. But I would like to point the attention to the fact that there is a huge interest in the academic arena from a research point of view. So there are many aspects that have been studied in the last years. So for sure, the drivers, so understanding what's important, what can be used to understand whether an ICO will be successful or not. That is one of the main point of interest in the literature. On the other, from another point of view, of course, the role played by scams, by fraudulent activities, that is really impacting and can bias the perception and can, of course, harm all the consumers and pose an issue from many points of view, also for regulators, of course. But also, for example, the role played by social media. So for ICOs is particularly important, the roles played by social media. So the way in which promoters of the ICOs try to engage possible prospects clients by using Twitter or using especially Telegram. Telegram is a particular channel of interaction used by ICOs, but also the way in which white papers are drafted, are put in place, are designed. So by analyzing white papers, we can understand a lot of the characteristics of the business idea. Sometimes we notice that the literature, the studies notice that white papers are just copy and paste of other white papers. So it's just a way of saying, okay, we have a white papers, but we really don't put so much emphasis on the business idea. And so this is a signal, a clear signal of something wrong or something that is going on behind that ICO. So even the white papers and so all the specific type of analysis that you should run by using what papers are based on text. So you need to put in place text analysis, text analytics in order to understand the information available within. And that's another very interesting research lines. So in this specific paper, the idea is, okay, to use the most up-to-date machine learning algorithms in a comparative ways, and this is really interesting. The analysis have been run in a very rigorous ways, but I would like to underline an aspect that everything, so all the performance of these models and the comparison hereafter depends upon the target, the definition of the target, okay? So in this specific paper, the definition of scams is as was declared before, all the scams, all the ICOs that are not active anymore, was added by the authors, and the previous definition was all the ICOs that were collecting less than 1 billion. Okay, so this is a definition, but the issue is that there is no unique definition of scam. So if we agree on this definition, we result in having a pretty balanced target variable. So scam and not scam, so we are around not exactly 50-50, but it's something like 40-60%. This, as you can imagine, from a technical point of view, from a modeling point of view, has an impact, because according as you define the target variable, you can get different results. If you decide to be more restrictive and decide to define as a scam really fraudulent activities, so all those ICOs that have been signaled by SEC announcement or by blogs or by some webs that are able to somehow label scams or to understand whether they are scams, of course you have a totally different definition, a totally different labeling of the data set, and you will result in having something like 10%, 20%, 50% of scams. So in that scenario, you will probably find different results. So it's important also to have a sort of unique definition of scam ICOs. So if we stick with this definition, we will use this data set that is made of 305 ICOs between 2016 and 2018. Many information collected, many variables. So the original data set accounts for more than 130 variables. Then the authors try to apply some feature engineering manipulation, and this is necessary because the data set is relatively small. We have 300 observations, 300 units, and we are trying to evaluate more than 100 observations. So we need to put in place some strategies to reduce the size of the data set. Otherwise, you can have issue in fitting in a reliable way the model. So a huge plethora of variables of information, all collected ex ante, and this is a clear added value. So the idea is that we would like to understand with the information that is available to consumers whether the ICO will be successful or not. There are the three research hypotheses, so characteristics, analyzing the characteristics ex ante, putting emphasis on nonlinear models, nonlinear machine algorithms, and also understanding whether the success of the ICO venture depends on their technological capabilities. So the authors were able to respond to all these research questions in a robust way. With some, these are some of the findings. I don't want to replicate what has been said so far. I would like to, let's say, pose some open questions. So, for example, the quality of the data. This is a huge problem. There is no unique database where you can find reliable information on SEOs. So that's a really huge problem for having reliable results and reliable and robust analysis. Most of the time, you are forced to collect by yourself the information by comparing many different databases, because the information are not consistent, are not reliable in the same ways. Sometimes you have some information, for example, white papers are contained in one database, but they are not contained in another one. So that's a big issue. And this also is the reason why the data sets that are around available are typically small in size. In this case, we have 300 ICOs analyzed. I did a couple of papers by myself. And again, the size is that one because it's difficult to fine tuning and cleaning by themselves, let's say, the information in order to have reliable results. So it's an issue. The open issue is having a unique dashboard or a unique database where we can register and collect from which we can have the information in a reliable way. Of course, research is important in this arena because we need, as was already said many times at the beginning, at the opening of this seminar, and also from Guayano from HESMA, is important to have a unified and clear regulatory framework to protect consumers and also to avoid any banning effect. We need to regulate somehow. We don't want to ban, because of course these are all important technological transformations that we have to follow, that we have to study, and that we have to channel towards safer, let's say, safer places in order to protect consumers, but not to avoid them, to have alternative way of investing or having a more, let's say, inclusive financial world. One of the aspects that was raised by the author, by the presenter before, the colleague, was that on test set you find out, let's say, somehow less robust performance. I suspect that this depends on the size of the data set. When you use nonlinear models, typically you need a lot of data in order to have reliable and good enough results. So I think that's the reason why probably you don't have comparable results also on the test set. And let me say also that logistic regression typically doesn't work that well when the target variable is balanced or pretty well balanced, as in this case. There is a problem of robustness in the estimation of the coefficient and of the standard errors. So I'm not surprised by the fact that other models, so nonlinear models, are more effective in predicting the target variable. I would also suggest, maybe if you want, to explore discriminant analysis. Discriminant analysis is a sort of alter ego of logistic regression and works much better when the target variable is pretty well balanced, as in this case. Otherwise, you can also try to investigate what happens if you change the definition of the target variable. Since you have the data set, maybe you define scams in a different way, so you can see what happens to results. This is, of course, a robustness study. What happens if we define scams differently? Do the drivers that I found previously remain? Are they robust, or do I have a completely change in the size or in the significance of the drivers? And finally, I really appreciate the fact that the authors devoted time in doing analysis from the explainable AI, explainable artificial intelligence point of view. We all know from academia, but for also practitioners, that nonlinear or complex models tend to be more performing, especially when you have many data and many variables, because they are able to exploit the nonlinearities. But the drawback is that they are black boxes. And so this is an issue for regulators. We all know that this is a big issue. So now is rising this concern about the fact that we need both performing models like the nonlinear ones and the non-black box effect. So we need to invest, we need to do a lot of research on explainable AI. So the authors use some of these scores, permutation scores or partial dependence scores, that they are tools that use for, especially for, specifically for this purpose. There are many others, like Shapley values, for example, but a lot of research is posing emphasis on this aspect, and I would like to see more and more in this direction for all the colleagues or the scientific context, because there we could, in that way, we could have a sort of win-win scenario. Performing models, highly performing models, but also explainable. So also able to be communicated in a transparent and reliable, understandable way to policymakers, institutions, regulators. That's, in my opinion, is our last challenge that we have now. So many thanks. I hope that I stick with the timing.
Thank you, Paola, for having shared your reflection with us. I don't know if Piotr want to add something.
Yeah, thank you very much for all these comments. I agree that the crucial importance is, for example, for also in trying to extract some more information from the white papers, right? Not just having a white paper, but also the contents of the white paper, which might be very important. And explainability, of course, is the clue in case of applying nonlinear models. I would not agree that LDA would help much, because SVM, which we use with linear kernel, is a kind of let's say
similar, yeah.
Similar, right, to LDA. So it won't. I mean, we tested LDA, didn't help much. It has similar results as logistic regression. Yeah, but it's also important to have more data, as you said, right? Comparing different databases. But the data availability is a problem here, as you know. It requires a lot of work, a lot of digging, a lot of data cleaning. So this was in fact a master project, right? So we had a limited time. We had to finish it before the time. So that's how it worked. But thank you again very much. That was a very interesting comment.
Thank you to you two both. And I want to ask Nadia Linciano if she want to compare. Yes, on our screen. And I don't know if there is some Q&A questions. So I suppose that we have finished our time, but I want to ask to Nadia if she want to conclude this.
Yeah, thank you very much. Thank you very much, Ida. Actually, we are beyond the scheduled time, so I will be very, very brief. Many thanks to you all. This webinar was very inspiring to us as a securities regulator, because as said also by Commissioner Paolo Ciocca, we need evidence to carry out a proactive regulation, and we need also academic experience, academic work to move towards the use of new technologies to gather and analyze data. As from our side, and I refer to Consob Research Department, we are starting to gather evidence and on a regular basis and to analyze and publish it. in fact, we launched our first reports on sustainable investments and crypto assets at the end of June, and our idea is to move forward with that and also to include new analysis that may be also inspired by your very relevant papers. I really hope that we will be able to meet in person with you all. Personally, I'm a little bit fed up with webinars. But anyway, let's keep in
operational
touch.
risk to be managed.
Yeah.
You know.
So let's keep in touch for the future. And thank you very much to you all, and to Marina, Ida, Valentina, Francello, who helped a lot with the organization of this seminar, and thank you very much to presenters and discussants.
Thank you to all. I suppose that the main conclusion is that we have many tasks to carry out, each one for his fields, and a lot of things to do. And this is very stimulating for all of us, the researchers and you. And this kind of cooperation, this kind of experience could help improve the knowledge and foster that safeness and that functionality of the markets, and that we all hope it will be realized. So let me say hello to everybody, or ciao ciao, that is maybe it's better. A nice Friday and a nice weekend too. See you.
Thank you very much. Thank you to all. Bye bye.
Ciao, bye.
Thank you. Bye bye.
Thank you. Bye bye.